Well, there's going to be, I think, global widespread implications from this significant development. The conflict in the Ukraine, we think, is going to have kind of two main impacts. Firstly, it's going to have a negative impact on growth. And secondly, it's also going to make the inflation outlook even worse than is currently the case. So I think in terms of the main impetus, that's going to be a kind of stagflationary shock for the global economy. Obviously, in terms of which economies are going to be hit the hardest, that's obviously going to be the Russian economy, which is going to be hit hard by the recent sanctions that were put in place by the Western powers. They've clearly ratcheted up the scale of those sanctions. The new sanctions are going to effectively take Russia out from the Western financial system. And at the same time, they're also going to sanction the Russian central bank so that it can't utilize its FX reserves to support the economy and the financial system there in Russia. So we should expect a deepening recession in Russia, and that obviously will have negative spillover effects as well for the surrounding region over into Central and Eastern Europe, where we will also see downside risks to growth increase. And then finally, in terms of kind of the global impact, we think there are probably two main channels through which this shock could have a bigger negative impact on growth and inflation going forward. Firstly, there is the channel of higher energy prices and food prices, given concerns over supply disruptions from Russia. That will obviously put upward pressure on inflation, which is already elevated, and lead to a bigger squeeze on household incomes. And then secondly as well, we also have the potential for a negative shock to come through the financial markets in terms of if we see a sharper sell-off in global equity markets, that will lead to a tightening of financial conditions globally. And that as well will lead to a further downside risks to growth going forward. So to kind of summarize, our view is very much that this is a worsening situation, and that the longer the conflict goes on, the greater the downside risks to growth going forward. Well, the clear winners in the FX market from the Ukraine crisis have been the US dollar and the Swiss franc, which have outperformed in recent weeks. We expect that trend to continue in the short term. We've now lowered our forecast for euro dollar, and we think there's a higher risk that that will fall below the 110 level. Similarly, euro Swiss as well, we think could fall towards parity or below, reflecting these heightened security concerns. The relative appeal of the dollar is also boosted by the fact that this is more of a Europe-specific shock, so we would expect Europe's economy to be hit harder than the US economy. That as well is going to have implications for monetary policy from the ECB and the Fed. We've already heard from some ECB officials which have suggested that they will look to potentially delay their plans to tighten policy, whereas we're more confident that the Fed will likely continue with plans to start raising rates this month. Admittedly, we think a smaller 25 basis point hike now makes more sense than a 50 basis point hike, but the path is still towards higher rates in the US. So that possibility there of policy divergence opening up between the ECB and the Fed is another fundamental reason why we expect euro dollar to head lower. Outside of those major economies, the other currencies which have obviously been hit hard by the crisis in the Ukraine have been the Central European currencies of the Czech Koruna, Hungarian Forint, Polish Zloty. We would expect those currencies to continue to trade on a weaker footing in the short term, to reflect the fact that there's now obviously much higher security concerns for those countries posed by a more expansionist Russia.